Well, it was really unprecedented, which is a word that's been way overused since the start of 2020, but just experience with the coronavirus pandemic. It's no surprise that the market did decline as much as it did. I think what probably did surprise a number of investors was how quickly the market rebounded from that low. So, how do we explain that? I mean, I think that there were really two main factors that we should look at. And the first is that the panic that was enveloping the market in March subsided. I think what's even more important was the government acted quite quickly with a $2 trillion stimulus bill. And so I think that that was also probably the most significant factor in driving the turnaround in the stock market, along with the actions taken by the Federal Reserve, such as rate cuts, reserve ratio reductions. It was obviously a very difficult environment for investors in the first quarter. I mean, who's used to seeing the market go down 9% in a day? And in that sort of environment, it's not surprising that some people have the reaction that I just want to cut and run. I don't know what's happening here. I have to protect myself. And the one piece of advice that we have given consistently over the years is that your best course of action is to remain invested. It may be that the market rolls over. We've seen an increase in coronavirus cases and through large swaths of the country, and that's again having an economic effect. But it's also entirely possible that the government decides they need to do another stimulus bill. I mean, so we continue to stand by our probably single most consistent piece of advice that your best option is to remain invested.
Right at the beginning of the second quarter, we had a big fiscal stimulus bill in the US, and other developed countries have also launched dramatic levels of fiscal support. And that's one of the things that helped buoy the stock markets in Q2. But on the horizon, it's worth keeping a lookout on the levels of public indebtedness relative to gross domestic product, to GDP. When public debt levels have increased to a level that is greater than GDP, any increase in interest rates from that point needs to be accompanied by an even greater increase in real economic growth in order to be able to finance the interest burden from that increase in interest rates on the public's debt. And that's a tricky situation. So that's just something on the horizon to be wary of as governments are focused on the more short-term concerns of, financing and providing fiscal support to get economies back to the levels that they were pre-pandemic.
While the first quarter performance is really driven by U.S. Treasury bonds held in the portfolios, the second quarter, on the other hand, the positive performance was driven by the U.S. corporate debt and the recovery of corporate yields, specifically in the triple B sector. We believe that as investors, we have to continue to exercise caution since due to the very slow recovery the U.S. is facing to get COVID-19 under control, that corporate credit will continue to be eroded. Going into the second half of the year, we're really going to be viewing this debt with increased scrutiny due to the heightened risk of downgrades.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate, so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting www.sextantfunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the Sextant funds in a free prospectus or summary prospectus, please visit www.sextantfunds.com or call 1-800-728-8762.